Investing in a rental property can be a nice way to make extra income, but many people who are capable of making the investment feel intimidated by the possible tax implications. There's really nothing to be worried about. In this video, we will briefly discuss some straightforward tax aspects of running a rental property. Then we will go more in depth on 4 subjects, those being any gain on sale of the rental property, revenues and expenses on the property, interest on a mortgage, and possible losses. Follow along for the next 15 minutes, and at the end you should have a much better understanding of what it means to have a rental property from a tax perspective. To start, let's cover a few basics that you are certain to encounter in your first year as a landlord. If you are just starting in the rental home business, you are most likely using a cash-based method of accounting. This means that you will report the revenue when it becomes available to you and not when it is actually earned. An example of this is, if you were to take 3 months rent in advance on December 1st of 2014, the entire 3 months rent would appear on your 2014 income, regardless of the fact that 2 of the months the rent applies to are in 2015. Security deposits do not count towards your income if you still intend to give the money back. But if you end a lease and are withholding any money from the deposit for damages to the property, the portion which you withhold is included in your income for that year. Any expense the tenant pays for you and deducts from rent must also be included in income. For example, if your tenant is a painter who offers to paint the outside of the house in exchange for not paying rent next month, that month's rent is still considered income. Another example would be if a pipe breaks and the tenant calls a plumber to fix it and deducts the bill from her next month's rent. The cost of the bill is included in rental income.
For inheriting a house, and if you wish to sell it right away, you would be subjected to the tax code section 1014(1)(a). The amount that the house will be recognized is at the fair market value of the house at the time it was inherited. Also, even though it is not a capital gain, it will still be treated as a capital gain, and therefore all of the profit made of the sale will be subjected to being taxed. Profit from selling the house held less than a year is taxed at your regular rate. If there is a property that you have inherited and you have thought about renting it out, the following are qualifications needed to be considered a rental property to record a gain on sale. The qualifications require you to own the house for 5 years. Within those 5 years, there needs to be a minimum of 2 years that you live in the house as a resident. Therefore, if you complete these 2 tasks, you would pass the ownership and the use test. If you were to make this a rental property, those are the 2 steps. If you pass those qualifications, that would lead you to pass the ownership test and the use test. If you were to make this a rental property, those are the 2 steps that first need to be passed to register as a rental property. For a single taxpayer, if they are qualified for both tests, the maximum excluded gain of the sale is up to $250,000. For a married couple filing jointly, taxpayers are qualified for up to $500,000 of tax exclusions. For any profit that exceeds the ceiling for your filing status, you pay the capital gains tax rate, generally 15% as of 2013. Although there are exceptions according to section 121B(4)(5), which states unforeseen hardships, which for example are if you have to move because of a loss of job or illness, you might not have to pay that tax. If a hardship were the cause of your reason to sell, how you would calculate the maximum exclusions would be you would take the full extension. If you lose money on the sale, the tax laws don't help you. According to section 165C, if you lose money on the sale, there are no tax laws that will help you, and therefore there will be no tax benefit for your loss. If you have depreciated the property, you might pay a different rate. For example, if you buy a rental house at $300,000, take depreciation deductions of $100,000 over the years, and then sell it for $320,000. Your gain for taxes is $120,000, but you pay at 25% rate on the first $100,000, the amount you deducted for depreciations, and the 15% capital gains rate applies to the $20,000 gain remaining. To report your gain from the sale of the rental property of your personal income tax return, use Schedule D to report the transaction and attach it to your Form 1040 before mailing it to the IRS. If you lost money on the sale, you can use the loss to offset the capital gains for the year. Your unused capital losses can be carried forward and used on future tax returns.
There are 3 different categories for a rental house depending on how much the owner would like to use the house for personal purposes: residents with minimal use, residents with significant rental use, and non-residents. Each of these 3 situations treats revenues and expenses in a different way, leading to different taxes, deductions, and benefits depending on the way the property is treated. Here we will go over each in turn, detailing the pros and cons of each. The first of the 3 is residents with minimal rental use. To qualify under this situation, someone would have to live in the house during the taxable year, 14 days or more, and rent the house for less than 15 days, according to Section 280AG. According to Section 280AG, all rental income is excluded from the taxpayer's gross income and no deductions for rental expense may be taken. Under a situation like this, any revenue made during the rental period would not be reported and thus would be tax-free. However, expenses also cannot be deducted, meaning that residents with minimal rental use can be favorable in a good year, but unfavorable when incurring any expenses that cannot be deducted normally outside of rental conditions. The second situation is residents with significant rental use. In this situation, a taxpayer would have to stay in the house for longer than the greater of 14 days or 10% of the days the house was rented, according to Section 280AD1. For example, if the house were to be rented out for 240 days of the year, a taxpayer would need to stay in the house longer than 24 days. If the house were only rented for 120 days of the year, a taxpayer would have to stay in the house for greater than 14 days. All of the revenue in this situation must be recognized. However, all expenses in the course of normal rental business can be completely deducted so long as they do not exceed gross rental revenue. If expenses are greater than gross rental revenue, the expenses will be split into tiers and may be deducted to the extent of the revenue according to Section 280AC. The tiers are as follows. Tier 1 consists of expenses for obtaining tenants and expenses allocated to the rental use of the home that would be deductible as itemized deductions even if the home were not rented. Tier 2 consists of all other expenses allocated to the rental activity except depreciation expense, including payments for utilities, maintenance, and other direct expenses. And Tier 3 is depreciation expense. Tier 1 is deducted first, then Tier 2, and then Tier 3. Anything not deducted in the current year will be carried over to the following year. In either case, deductions must be split up between personal and rental use according to Section 280AE1, and expenses allocated to personal use cannot be deducted unless they would be deductible even if the house was not rented, according to Section 280AE2. Be careful here, though. The IRS and tax court account for all the expenses the same except mortgage interest and property taxes. Allocation for those is determined by expense times total rental days divided by days in a year. All others are determined by expense times total rental days divided by total days used. The third and final situation is non-residence. To qualify, a taxpayer would need to rent the house for at least 1 day, but could not live in the house for longer than the greater of 14 days or 10% of rental days. For example, if a taxpayer rented their house for 200 days of the year, they could not live in the house for more than 20 days. If they rented for only 130 days, they could not live in the house for more than 14 days. Just like in the second situation, rental revenue must be reported to gross income. Once again, expenses may be deducted from gross revenue, and they must be split up by usage according to Section 280AE, but this is where things differ. In non-residence, mortgage interest, when allocated to personal use, may not be deducted because the home would no longer be considered a qualified residence. Real property taxes allocated personally would still be deductible, however. One other difference is that expenses in excess of revenue are not carried over into the next year and are instead counted as a loss on the financial statements.
A rental house may have a mortgage on it. Usually it is ill-advised to pay off a mortgage in advance. It may seem appealing to lower the monthly expenses, but upon closer inspection it may not be in your best financial interest. A mortgage is considered a good debt, and as long as your interest rates are good, somewhere in the neighborhood of 4%, then you are probably better off letting it go, especially if you have other bad debt, like high interest credit cards, auto loans, or payday advances that need to be paid off first. Even things like making the maximum contribution to your retirement should usually be prioritized above an advance payoff for a mortgage. One of the main reasons why this is true is because in most cases, even if the home is a rental home, the interest on the mortgage is often deductible. You may deduct mortgage interest on up to 2 houses, so if you only own your home and 1 rental property, then some or all of the interest expenses from both properties may be deducted. How much of the interest you can deduct depends on how the rental property is used. Recall earlier that we made the distinction between residents with minimum rental use, residents with significant rental use, and non-residents. These categories come into play again when considering the tax treatments for mortgage interest expense. If the house is a residence with minimal rental use, the qualified interest expense is deductible as an itemized deduction from AGI. If the property is a residence with significant rental use, then you must first allocate between personal use days and rental days. The interest allocated to rental days is deductible as a rental expense. Interest allocated to personal use days are deductible as itemized deductions from AGI. If the property is a non-residence, then you must still allocate between personal use days and rental days, and the interest for rental days is deductible as a rental expense, but interest allocated to personal use days is not deductible.
If a couple with an inherited home decided to keep the home as a non-residential full rental, they can be subject to a rental tax loss. If the owners of this hypothetical home wanted to take advantage of this, they would have to follow the rental or vacation home terms of not living in the home for more than 14 days or 10% of the total days it is rented out. In this scenario, the loss would not be a gross income limitation, but instead would follow the rules of passive activities. Passive activities are activities which are broken down into specific expenses that have to do with the rental real estates. The IRS's publication 527 and 925 and topic 415 and 425 states the terms and rules to follow in a rental loss. They also present forms for which you need to document these expenses and activities pertaining to your losses. These documents help you find your standing on your possible passive activity loss deductibles. If you actively participate in a rental real estate activity, you can deduct up to $25,000 of your rental loss even though it's passive. When we say actively participate, we mean that you own at least 10% of the property and you make major management decisions, such as approving new tenants, setting rental terms, and approving improvements, and so forth. These terms are also laid out in U.S. Code Section 469. In the event that you find yourself in a rental loss, it is possible to deduct part or all of your loss through a phase-out process as your income increases. The phase-out process is calculated by taking 50% of every AGI dollar between $100,000 to $150,000. For example, if the owners of a home decided to fully rent it out and ended up with a rental loss of $10,000 and they had an AGI of $130,000, it would be calculated as seen on the screen. First, you would take 50% of that $30,000 worth of the AGI that is over $100,000. This comes out to $15,000. Then, taking the phase-out amount from their current AGI of $15,000, the new maximum amount they are able to deduct for rental losses becomes $10,000. This is found by subtracting the phase-out amount of $15,000 from the universal maximum deductible of $25,000 explained before. In this scenario, the rental loss totals at $10,000, and as calculated, their max amount deductible is $10,000. So fortunately, they would be able to deduct all of their loss under these circumstances. In another scenario, if the owner's AGI was calculated at something more like $160,000 and their loss stayed the same at $10,000, none of the rental losses would be able to be deducted because their AGI exceeds that limit of $150,000.